Bear Market Watch 2019. I know I told you guys I would do these videos once a week, or I guess we're doing once every 2 weeks. But we got to check the pulse of the market, see how it's doing. Is the bull still alive? Is the bear here? I really don't have that many variations of this same intro. But let's jump into it. And of course, I'm not smart enough to do this, so we have Alex from Macro Ops, our most favorite analyst, the smartest guy we know. So he says the primary trend in US stocks is obviously up. Liquidity is flush and longer term indicators of positioning show that investors are still very underpositioned in risk, which is not something you see at market tops. And by the way, if you want to catch up on all these videos where I track the market, then just watch this playlist right here. I'll put a link and you'll kind of know what we go over, because we go over technicals, we go over fundamentals and sentiment, the markets trifecta, which hey, I made a markets video the other day. You can check that one out too. But as we talked about in the last video, the current rally is kind of long in tooth, and there's some signs of growing complacency and some technical divergence. For example, if you look at this chart right here, this blue line is the S&P, and this black line, well, with the bars, that's IWM. IWM, which are the small caps, they are not confirming the broader market. In the healthiest market possible, you would have both of these going up. Now, obviously, they've been decoupled for a while, but if you look at the latest data right here, you can see that while SPY is going higher, IWM is actually heading lower. So that is something to watch, that technical divergence. Alex says we've also seen credit in the junk bonds and spreads turn over a bit in the last few days. So these aren't major warning signals yet, because they could easily correct and improve in the coming days, but it is again something to keep an eye on. And we've talked about this before, right, in the previous videos, but a majority of investors have been on the sidelines during this rally since the start of this year, really. And we've talked about it. This move will keep going until it finally creates enough FOMO. Should I plug the FOMO guide? I haven't done that in a while. No, we won't plug it. But it will persist until we finally create enough FOMO that the players who've been sitting on the sideline finally jump in. Can't handle it anymore. Gotta get in on the action. So we likely have some ways to go before we see that total capitulation from the bears, but there's increasing signs that we're getting close. And think about it, if you see that investors are on the sideline, that's actually a good thing for the bull market, because they have fuel to put in the market to push prices even higher. Someone's got to be buying for prices to be going up, right? But if all the bears were already in the market, then how are prices going to go higher if everyone bought? So that's why we watch this type of thing. So you can look at this extreme exposure index, which measures the top quartile of investors weighting to risky assets. It's this yellow line right here. Recently it pierced above this 80 level, which is this red line. And when it gets past this level, this 80 level, that kind of signals that investors are over their skis a little bit, which means they're overexposed, have too much money in, and that makes the market more susceptible to a pullback. And remember, we're looking at different time frames here. So this exposure index is a little more short term versus what we talked about before, which is more long term. Because overall, long term, all the bears haven't jumped in yet, but short term, maybe a little overextended. Markets. Investing in markets is all about looking at the different cycles and how they work together, short versus long versus intermediate term. So you got to keep that straight in your head, and you got to understand what time frame your strategy works on. It's the classic mistake when people say, oh, I'm a long-term investor, and then they jump out of all their positions with just a little bit of volatility. Can't be doing that. And this AA bulls and bears survey shows that there's not as many bears left, and this is again another shorter term indicator. But you can see the amount of people bearish is this blue line, and it's reaching cyclical lows, and the amount of people neutral is going up. And this is not something you necessarily want to see, because a healthy bull market should have a bunch of skeptical bears. That's what the wall of worry is, if you've ever heard that term. There should always be a bunch of bears worrying about something, saying they're not going to put their money in, and then somehow the market always climbs that wall of worry because those bears slowly capitulate. But if there is no more wall of worry and everyone is just super bullish, well, that's when things might start turning around. Like we always say, bull markets die on euphoria, not pessimism. So it's counterintuitive, it's kind of opposite, and that's why we measure sentiment. And somebody had a good question on that Michael Marcus video I was telling you about. Squallow over here, he said he's curious as to how I incorporate market sentiment into my stock picking system. Could you do a video on market sentiment and how you change the way you trade based on your perception of the general market condition? Now, if you want to see how to use sentiment in trading, well, you just saw it in this video, right? And you can see it in that series of videos. Like I said, I linked to it above. So that's kind of how Alex uses it in his trading. And he's a global macro discretionary trader. He's doing a lot of things that are way more complicated than I can do. He's much smarter than I am. But when it comes to me, how I use sentiment in my strategy, which if you don't know, it's an automated momentum system called the Nasdaq All-Stars. If you want to learn more about that, I'll link to this video where I explain it. But basically what the system does is rank stocks based on their momentum, and then I invest in those top momentum stocks. So in a system like that, I'm not really separating out fundamentals and sentiment, because all of that, with the way I look at markets, all of that is included in the price itself. So I know if I measure the momentum on a stock, right, and I look at a stock chart, if the price is going up, then sentiment and fundamentals must be good. And well, actually fundamentals, they might be bad. It's kind of an opinion, how you look at it, right? Which is kind of how sentiment comes into the picture, because even if the fundamentals are bad, but the market likes the stock anyway, well then it's gonna keep going up. So I get all that information in the price itself. And I'm not saying that's the best way to do it, but it is the best way for the strategy that I use. And it kind of fits with my personality. I like momentum. And just for an example of that, you could take Facebook's recent earnings today, or I mean on the 24th. They had a big miss. They actually surprised to the downside. Their earnings came in less than what estimates predicted. So I know this is simplistic to say, but let's assume that the fundamentals were bad because it didn't come in near estimates. But look what happened. The stock popped over 6% anyway. So what does that mean? Like, how are you measuring fundamentals and sentiment in that case? Well, when I look at something like that, that tells me that the sentiment is really positive. It tells me that the market loves Facebook. And that's why I say that price tells me everything I need to know. Now, another way to look at that, if you're employing a different strategy, is perhaps maybe you look into Facebook's fundamentals and the earnings report yourself, and you think, no, this company sucks. They're screwing up. They're missing earnings. This is not a good value. But you see the stock price pop anyway, so you know that sentiment is on the side of Facebook right now. So in that case, even though you think it's overvalued, you might not be shorting it just yet, because you don't want to short against the sentiment, right? So in this case, if you're a value guy, which I don't think value guys really short that much, but stick with me. Maybe knowing that, you sit and you wait, because you know the fundamentals are bad and now you're just waiting for the market to realize it. You're waiting for the sentiment to change. So once you see Facebook's run start turning around, when you get some confirmation in the price, you know, the stock price going down, maybe that's when you jump in, because your thesis is being confirmed. Your fundamental research, the sentiment is turning. Market is seeing what you saw. And in Alex's case, you know, with all this we just went over with the sentiment, the way he uses all that data is it goes into his total mental picture. And it's pretty discretionary, just like a lot of the macro traders of the old. It's more of like an art than a science. In my opinion, he might think differently. But you have all these different data points, so you could form a picture of what's possibly going to happen in the future, and you make investments based off that. So I gave you like 3 different ways that sentiment and fundamentals can be looked at. How you use it is just going to depend on your strategy. I try to use it the most simple way possible because I'm a simple guy, but it works. Returns are good. A lot of ways to skin a cat in the market. And if you want to learn more about skinning market animals, then make sure you subscribe to this channel and hit that notification bell so you get an email notification when our next video comes out. I'm publishing videos almost every single day of every week. I've been missing a few lately, I'm sorry. But we publish all sorts of videos all about markets and business. It's really interesting. It's fun. Come hang out with us. Subscribe, and I will see you in the next video. Stay fallible out there. Bye.